We have all witnessed many financial crises due to credit since the Great Depression. In fact, very recently, starting from 1990s, we have witnessed many financial crises. These financial crises have been the biggest motivation for financial researchers to study and analyze credit risk. Credit risk is not only at a firm level, but it is also at an economy level. For example, the overvaluation of the real estate markets in Japan led to a huge bubble, and next the bubble burst, and in the 1990s we saw what happened in Japan. Even to this day, the debt to GDP ratio of Japan is the highest in the entire world. After the Japanese debt crisis, next we talk about the tequila crisis that happened in Mexico between 1994 and 95. The crisis saw its origins in the devaluation of peso, and then the Mexican bonds fell crazily, right? Then the 1997-98 Asian crisis that happened with the currency Thai baht. And after that, the very famous crisis that happened in 1997-98, LTCM, long-term capital management. In fact, it was a hedge fund which was run by very famous finance researchers, Nobel laureates. But what happened to LTCM? This happened due to the Russian debt crisis in 1998. Russia defaulted on its debt in August 98. This caused huge losses on Russian bonds. This spread to the equity markets as well and turned out to be a contagion to the global markets. On September 15th, 2008, Lehman Brothers went bust. It was a crisis where everyone were talking about, too big to fail, but Lehman Brothers was too big to fail, and it failed. And after this crisis, we saw many banks, running around for some governments to bail them out. The governments also spent taxpayers' money to bail these banks out. But even till now, just a few arrests have happened, and nobody knows who is responsible for a crisis such as the one that happened in 2008. The credit crisis of 2008, as it is famously called as, also led to European bank runs in 2010 and 2011. The credit crisis of 2008 showed the world the importance of measuring credit risk of a firm before a loan was issued. The financial crisis had a negative impact on trust in the banking system. In fact, the financial crisis of 2008 was another very big motivation for the world to turn towards technology in finance. In fact, it was the beginning of fintech. In 2008, everybody talks about the famous paper of Nakamoto, and this led to the beginning of blockchain in finance, and of course, the beginning of cryptocurrencies. The COVID-19 crisis was another very big nail that pierced through the income statements of all the firms. And in fact, many firms actually stopped running because of this COVID-19 crisis. The smaller firms closed down. And if we looked at all these crises, we looked at the crisis that happened in Japan, and most recently the COVID-19 crisis. Now, these credit risk crises or the credit crises happened, and the entire world had to suffer. So what is this credit risk then? Now, what do we understand when we say that someone is facing credit risk? Well, let me just explain what is credit risk now. Imagine that one of your friends needs money and comes to you asking for it. But you would like to understand whether that person would be able to give you back that money that he is going to take from you. Now, this is what is called as credit risk. Credit risk can be of two types. One is called as default risk and the other one is called as counterparty risk. Default risk is the risk borne by a financial institution due to the debt obligation that the firm or an individual will have with the financial institution. Well, default of a borrower can occur due to reasons such as failure to meet the interest payments or failure to meet the principal payment back to the financial institution. Then what do you mean by counterparty risk? Well, counterparty risk comes in the picture of a derivative transaction. Well, in this video, we will concentrate only on default risk and not on counterparty risk. So, why do investors have to know about credit risk? Because the bank, needs to understand the credit risk of a borrower. But what is so important that investors have to know and understand about credit risk of a firm? Now, the main reason for this is the pecking order principle. Now, what is this principle? Well, the first claimants of a firm when it goes bankrupt are the debt holders, and then the private equity holders, and last comes the equity investors or the stockholders or what are called as shareholders. So those are all of us, right? So we invest in that firm and we come in the end of the pecking order principle. The equity holders are the residual claimants when a firm goes bankrupt, and that is the important reason why the equity investors need to understand about credit risk. Now, prediction of default of a firm becomes extremely important in the current scenario. The reason for this is the increasing number of non-performing assets or non-performing loans in the financial institutions. Now, when we look at this graph, we can see that in India, gross NPAs increased drastically from 2.2% of total advances in 2008 to 11.88% in 2018. Even globally, the defaults had increased during the global financial crisis in 2009 and tech wreck of 2001. This graph depicts the global corporate default numbers from 1981 to 2017. We note that markets continue to recover post the global financial crisis when defaults hit a historical peak of 268 in 2009. The best source of knowing credit risk of a firm is through the credit rating that various rating agencies give to a firm. In fact, these ratings are given to a firm based on various financial ratios and various other governance variables of a firm. Well, the first credit analysis was done by John Moody's in 1909 of US railroads. Then Standard & Poor's came in and gave the credit analysis in 1916. Rating agencies such as Moody's, S&P and Fitch are in business of providing ratings describing the creditworthiness of debt. In India, CRISIL, ICRA, Fitch and CARE are the agencies which assign rating for the corporate debt. The best rating assigned by CRISIL is AAA. Bonds with this credit rating are considered to almost never default. Just below this rating stands AA. The other ratings that follow AAA and AA are A, triple B, double B, B, triple C, double C and C. Well, CRISIL may apply plus or minus sign for ratings from CRISIL AA to CRISIL C to reflect comparative standing within the category. In addition, rating agencies will typically provide outlooks on their ratings. They are positive, stable and negative. This provides a potential direction of their ratings. Why have credit ratings got so much importance? Well, the first reason for this is independent judgment. Investors always look for an independent judgment or analysis, and rating agencies provide just that. They also have access to non-public information, financial projections, and any other information that a normal investor would not. Ease of comparability. Ratings help us compare across issuers of bonds, issues, and various segments of the markets. Helps in better regulation. Well, these are used by regulators such as RBI and SEBI to correctly assess distress risk in firms. Well, another major reason why rating agencies are so important is because of the tremendous growth that the bond markets are seeing today. Now, people say that Indian bond markets are not so very well developed, but the bond markets are doing well and they are increasing nowadays, and hence credit rating agencies have proven to be extremely important for investors. In fact, the information from the bond markets gets leaked to the equity markets, and hence the equity investors like you and me also need to be aware of credit risk of firms. The two important credit related risks that an investor needs to be aware of are as follows. The first one is credit migration risk. This happens when a bond issuer's creditworthiness reduces. For example, let us say that as soon as the creditworthiness of a bond issuer reduces, the credit rating agency downgrades that firm, and hence the investor would want a higher return because he is carrying a higher risk. They can change rapidly over time, either up or down. You can see in the table the ratings of Tata Motors from 2008 to 2020. You can notice how many times the ratings have changed. Moody's had rated Tata Motors as Ba1 before JLR acquisition in 2008. It fell to B3 stable in 2009 June, Ba3 stable in October of 2009, and then to B1 negative in June 2020. And then there is another table where we see that over the long term, that is 1981 to 2019, higher ratings are more stable than lower ratings. Issuers rated AAA were still rated AAA 3 years later 87% of the time, while issuers rated in CCC or C category retained those ratings just 10% of the time, and most of them moved to default. This relationship between higher ratings and higher ratings stability holds even over long-term horizons. This credit migration risk would affect the bond issuer's creditworthiness and the return that a bondholder would demand for that bond. The second type of risk that a bondholder needs to be very careful about is that the ratings tend to lag the bond prices. The main reason for this is that the rating agencies take time to downgrade or upgrade the firm when news comes in. Hence we say that ratings badly are lagging behind the markets. This figure shows the price and Moody's ratings of Ford Motors Company's bond during 2008 credit crisis. We can clearly observe that the bond price went down sharply even before the Moody's downgrade happened and moved up sharply even before Moody's upgraded it. In 2009, Kamakura Corporation's Van Deventer and Robert Jarrow coined a term called ratings Chernobyl, which reflects the adulteration of ratings. They criticized the rating agencies for favoring big companies. The events of the credit crisis and the events of IL and FS in India show that the ratings intertwined with politics and corporate high-handedness. Well, the recent crises that India has been facing in the bond markets, definitely we understand this is a ratings Chernobyl in India. For example, in 2008 credit crisis, massive downgrades of CDOs and SIBs happened, even though they were rated very, very high. Now, these SIBs and CDOs were being backed by subprime mortgages, and that could be the reason why these massive downgrades happened. The problem for investors is that the credit ratings do not change very quickly, but the markets do, the firms do. The investors have to be very careful about the bias that these rating agencies have towards very large firms. And in fact, this is the reason why the rating agency bias is called as the ratings Chernobyl. Dramatic shifts in macroeconomic indicators and the risks that firms have underwent led to the default of countries, companies and individuals. If the credit rating agencies are not capturing credit risk completely, then what else do investors have to look at? In the next video, we will be telling you more about the various other tools that can be used to measure credit risk. So come back again. Thank you.